Inflation is here, 5.4% in June. That is from the previous year's June, so it's kind of a 12-month trailing. 5.4%. Should we be alarmed, Lyn?
Certainly, obviously, it impacts people differently. And so probably people like us are less impacted than people that say have a much tighter, difference between their income and their expenses, right? So people that are more sensitive to grocery prices and more sensitive to that sort of thing are getting pretty hit by this. And so, we are in a period where inflation is going up pretty heavily. And the key thing I think to keep in mind is that it's not like the same things are going up. We're kind of getting this cycle going out. So one of the big drivers of inflation over the past, say, 4 months was used car prices skyrocketing. There's actually ended up being a pretty big part of that component. We've also seen food prices go up, a bunch of other things go up, while we still had disinflation or deflation in some other categories, like for example, men's business clothes, for example, are actually deflationary, while you have things like used car prices are going up. And so it's kind of like things that are experiencing supply bottlenecks while their demand is still pretty persistent. They're the things we're seeing inflation in. And I think the thing to kind of worry about maybe, going into the later half of this year, the second half of this year, is rent inflation, right? Because this 5% inflation spike happened while rent inflation was actually decreasing. So it was still positive. It wasn't deflating, but basically went down from, say, 3% inflation down to like 2% inflation because you had, rent moratoriums and things like that. But we've got this big surge in house prices. And as rent moratoriums and basically all these different things kind of expire, we're starting to see a bottoming in that rent inflation. And if they follow real estate prices as they historically have, say like an 18-month lag, we should see some pretty significant rent and owner's equivalent rent inflation in the back half this year. So I do think that this is going to be stickier than some of the economists expect, and that there is still parts of the market to worry about. I'd be especially worried if I was in bonds, right? For example, investors that are overweight bonds and cash.
There's kind of money supply inflation, which is sort of Fed balance sheet level inflation. Then you have asset price inflation, which is the price of stocks and homes and assets that investors buy. And then you have CPI inflation, which is what we were just talking about when I asked you the question of like 5.4%. June year over year, that's large. And it seems like mainstream only focuses on that third component, right? That CPI inflation. But I'm wondering if all of these are somewhat tied together. You also mentioned like fiscal policy. It seems like once we start printing checks and actually giving it to individuals, that's when you start to get that CPI inflation to go up. Before that, when we were printing money and giving those to bank bailouts, it seemed like that inflation went into asset price inflation. Am I thinking about this correct? Is that like generally in the ballpark, or what edits would you have to that?
I think that's a pretty accurate way to describe it. And when I refer to decades ago, it's not only that 2008 crisis, but it goes back to, say, the late 90s. And so basically, I mean, you could actually go back all the way to 1987 under Greenspan, where we started to do this concept where the Fed begins caring about asset prices. So before then, they cared less about asset prices. But starting with that 1987 crash under Greenspan as the Federal Reserve Chair, they started to have a kind of an unofficial mandate to bail out the stock market when it crashes. And so that started in 1987. And then we started to see it in the late 90s when you saw long-term capital management for people that are aware of that big implosion that happened in markets. It's not really well versed among, say, retail investors, but most people are involved in, say, macro level trading or familiar with that. The Fed and the banking system basically had to bail that out. They could have chosen not to, or they could have done it in a different way. We started to get this concept of the Greenspan put, the idea that if markets go down, Greenspan will be there to do things. And so even when you had a dip in, say, the late 90s, right, after a massive economic boom, massive stock price boom, when you had a pretty small dip, Greenspan came in there, cut interest rates, and it was always very accommodative. Always erring on the side of lower interest rates, very accommodative, try to get those asset prices back up. And so that really kind of set the stage for the dot-com bubble. And then when that, fell apart, then they said, basically, we need to inflate a housing bubble, right? We need to get this all back up again. So they cut interest rates, and that kind of led to a housing bubble boom. And then when that fell apart, you had to reflate the banking system and then kind of prop up the stock market again. And so really ever since the late 80s and especially in the late 90s, they've been in this thing where they just keep pushing up asset prices and keeping interest rates as low as possible. And that really set the stage for a lot of things we're experiencing now. Those low interest rates basically incentivize companies, households, and all sorts of different entities to take out a lot of debt, especially because they're trying to buy, say, high-priced homes and things like that, let alone what corporations are doing with their balance sheet. And so that, we've had this kind of multi-decade structure of encouraging debt accumulation. And when you get down to where we are now, where interest rates, eventually hit zero and debt's extremely high, they've boxed themselves into a corner. I learn a lot from Ray Dalio and his concept of the long-term debt cycle, which is basically that in a normal economic cycle, like a 5 to 10 year business cycle, during the expansion phase, you get more credit in the system. Some of it's constructive, but then towards the end of it, you start to get, kind of malinvestment. People get overexcited about the market. They start, kind of losing their discipline. And then some sort of external catalyst comes along or some sort of policy error or something, and you get a recession, a deleveraging. And so you reduce that debt. The problem is the policymakers come in and they try to prop that back up rather than letting it run its course. Basically, you short circuit that deleveraging. And so debt doesn't go down to where it started. Interest rates end up at a lower low. And so debt starts going back up for the next cycle without having fully deleveraged. And so when you string multiple of those business cycles together, you get higher and higher debt as a percentage of GDP. You get lower and lower interest rates until you find out what we had, in 2008, and then especially here in back in 2020, was interest rates are zero, and there's all that debt in the system, and everyone's so highly leveraged that their next mechanism is to go down that fiscal policy route, which is actually where you get kind of that consumer price inflation. So lowering interest rates and doing quantitative easing is very good for asset prices. So you get asset price inflation. And then when you actually do that fiscal spending combined with that say monetization of those fiscal deficits, that's when you get an actual increase in the broad money supply very quickly, and you get outright consumer price inflation, because that's when you get more money in people's pockets, and so you get a big kind of shift from that environment you've been in for the past 10, 20 years. So when you look at, say, CPI, right, that's what people think of as inflation, that purposely excludes asset prices. It actually used to include home prices, but then excluded that. They exchanged it for owner's equivalent rent, which is kind of an indirect proxy for housing prices, but basically understates it. Because all of our major indicators of inflation, at least the ones that are often used by the government, the Fed, CPI, PCEs, all those different acronyms, those are measuring just the consumer part of that inflation, and they're doing it in a way that is, of course, controversial because they have all sorts of quality adjustments in there that people can disagree with. But basically, that's what they define as inflation, whereas you rarely hear about, say, the money supply.